Good afternoon, everyone. We'll get started. I think a few more people may join in as we kind of go through this presentation, but out of respect for everyone's time, I would like to try to jump right into this. We will have a little bit of time for questions, but you can also use the chat if you have any questions as we're going along, or you can just shoot me or through Dan or Zoe. You can reach out to me with any questions, or if there's anything specifically you'd like to discuss and how it may pertain. But the purpose of today is to just sort of go through all the rumors that are out there as far as tax law changes go, whether it's the packages that are a part of the budget, some other things that are being rumored. There was another proposed tax that actually came out yesterday or this morning. So everywhere we kind of turn, we're hearing more and more and more about tax law changes. So let's sort of start to weed through some of the rumors as they pertain to individuals as well as corporations, and so you can start to navigate through what may or may not affect you. And keep in mind, all of this is proposed. So the reality is, if and when changes happen, they won't be what we're talking about. It's going to be something along the lines, but at least you're going to have a better indication as to what's on the radar, what's in the presidential green book, so to speak, as far as potential tax changes for down the road. So, proposed budget for 2022 that was just presented within the last month. It's a $6 trillion budget. Has a tremendous amount of infrastructure, clean energy, and R&D money in the budget. And there's two key components to the budget outside of the normal operating budget. The normal budget these days for the government's running around $2 trillion. So these additional plans, the American Families Plan and the American Jobs Plan, are additional 10-year spending that are baked into this budget. And each of them has their own tax revenue packages in them, and each of them has their own quote-unquote benefits or where the money is going to be spent. But the America's Family Plan, their new taxes, or the new taxes associated with that plan, primarily go after the individual or small business owner, and the American Jobs Plan targets international corporations and much larger companies. But each of those plans, you can see, run around $2 trillion, and the estimated tax revenue that could be generated by these plans. As I said, the American Families Plan really focuses on individuals, small business owners, passive investors, so limited partnership entities, private equity, S corps, real estate investors, anyone who can take carried interest to lower their income. So a lot of this is, when you look at it, it's the private equity, hedge fund, investment banking world that really has drawn the target. They're the ones who tend to pay lower relative taxes to what their net worth is increasing, because a lot of what you might see in the media now doesn't talk about someone's income. It talks about their increase in net worth. And that's what these plans are really trying to target. The American Jobs Plan is going after corporations, large domestic corporations, as well as multinational corporations. And we'll touch a little bit on that, even though that doesn't necessarily directly pertain to I think anyone in the peer group system, but it's something you should be aware of, because there always ends up being unintended consequences of these types of plans. So individuals, ordinary income, they want to bring back up to 39.6. That's for individuals making just over $400,000, households making just over $500,000. The most punitive part of this plan is the way they want to treat capital gains. For anyone making over $1 million, they want to treat capital gains as ordinary income at that highest income bracket. Now, when it talks about for anyone making over $1 million, this isn't talking about people making $1 million of ordinary income. This is talking about adjusted gross. So this takes capital gains into consideration on that. So if a business owner sells their business for $5 million, they're going to be put in the crosshairs of this, and their capital gains are going to be 39.6% of that transaction. In addition to that, the NIIT, which is quote unquote active pass-through income, capital gains, depending upon where they're coming from directly and how they're derived, could be subject to another 3.8% in addition to the 39.6%. The NIIT is, and some of you may already be subject to this, depending on how you take your income, but think of it for an S-Corp owner who maybe is taking a certain percentage of their income as W-2, but the balance of their income is being taken as a S-Corp distribution. The NIIT is that, call it Medicare tax or Medicaid tax, that's being that's going after those other non-ordinary types of income. So what they're looking to do is expand that and attach that tax to more types of income. The other things about the capital gains tax that they're looking at is obviously capital gains are due at time of sale. So if you sell a company, sell an asset, sell a stock, sell a house, capital gains are due. But what they're looking at, and the two places that it's sort of terrifying that they want to attack this, is at death. There was always rumor that they wanted to take away the step up in cost basis at death. So historically, with the exception of 1 year, 2010, I believe it was, if you have an asset that you have a low cost basis on, at death, your family or whoever's inheriting that asset gets it at fair market value on date of death. So one of the things they've always talked about is removing that. So if you pass away, whoever inherits your asset inherits it at your original cost basis. In the event of a small business, that cost basis is probably going to be close to zero because of depreciation. What they're proposing in the current budget is to go a step beyond that. And what they're saying is, if you inherit an asset, the first $1 million is not going to be subject to capital gains tax. But anything above that, you will have to pay capital gains tax on at that moment. Hold on one second. I have to. Sorry, I thought I was going to sneeze. So what it's saying is, if you inherit a $10 million business, the first $1 million, and you keep that business, so you're running it, your parents own it, or parents owned it, or you own it, and you're passing it to your children who are in the business, and it's a $10 million business, the first $1 million of that business goes to them at original cost basis. The next $9 million of gain in that company, capital gains tax is due, even if the business has continued to be held, even if there's no sale of that company, they're going to owe capital gains at that time. And they're going to allow it to be spread out, I believe, over a few years if it's a closely held family business, but the government wants their taxes. They're taking it a step farther as well, saying, is, hey, if you're alive and you gift that asset to somebody, same thing. First $1 million, okay, anything above that, subject to capital gains tax at time of transfer, at time of gift. This has huge implications in the estate planning arena, where people are moving assets to trust or moving assets to children. It's going to potentially trigger capital gains tax at the time those gifts are made. Next component of it is 1031s. If any of you invest in real estate, they're going to cap eligible 1031s at $500,000. So if you have a business or a building that you own for $2 million and sell it and want to roll it into a new building, the first $500,000 is going to be 1031 eligible. The rest of it is going to be subject to capital gains. Again, that's a huge, huge tax implication for real estate investors or for anyone who has been able to take advantage of that in the past. Carried interest, again, this is primarily for going after the private equity market, but for anyone who's declaring income or taking income as carried interest, they want to treat that as ordinary income, because right now that's treated as a long-term capital gain. So that's a huge uptick in what that would be taxed as. And as I said, they want to expand the NIIT tax. Another one, this was actually, I just read about this morning. It was just talked about by Rep. Souza from New York, who's on the House Ways and Means Committee. He put this out, I believe it was yesterday or this morning, a one-time Patriot tax. And what this is he's proposing a tax, so one-time tax that's on somebody's net worth. So if you have a net worth of between $50 and $100 million, it's a 2.5% tax of your net worth. If your net worth is over $100 million, it's a 5% tax of your net worth. It's a one-time tax, and you can spread it out over 5 years, but they propose that could raise $450 billion. Again, I don't know how they would go in and determine that, because the way you can value closely held businesses, real estate, everything else. But again, this is the target that the highest net worth in our country have put on themselves, because of their wealth accruing in long-term capital gains that they very rarely realize because they don't need the money. On the corporate side, we're looking at C Corps being raised back to 28% from the current 21%. GILTI, which is a global income. So this is tax on multinational corporations, where you hear companies putting their intellectual property in countries like Ireland or other places, and then their U.S.-based company licenses it there to move the taxation from U.S. tax rate to a much lower, much more favorable international tax rate. This tax already exists, but they want to increase it from 10.5% to 21% to further discourage that. It's sort of the opposite of a tariff. It's saying, well, hey, if you're doing business internationally, we're just going to tax you anywhere, as opposed to when assets come into the country. And they also want to create a book minimum tax. So this is basically like an alternative minimum tax for an individual, but they want to create a book minimum tax of 15% for firms with over $2 billion in net income. So again, how do they get companies, like Amazon and some of these larger companies who it's always reported that they barely pay anything in taxes, if anything in taxes at all? They want to go after them this way. And this table just shows you in billions what some of these tax increases could generate projected on an annual basis. So you can see that the raising the corporate tax rate from 21 back to 28 really has the largest impact. But raising the taxes and tightening the rules on the taxes for these multinational corporations and making sure there's a minimum tax that's paid to the U.S., when you look at the tightening the rules and the raising the rates, it's a pretty big number as well. Another tax proposal that this is actually, the Secure Act has gone through. The Secure Act 2.0 is working its way through. This is much more of an effect on individuals. This is, if any of you have ever inherited an IRA, you have the option to stretch it potentially, which means you can take required minimum distributions over your entire life. That no longer exists. Now, if you inherit an IRA, or if your children inherit an IRA, it has to be fully distributed within 10 years of the owner's death. There's a few exceptions to that for young children or for people with special needs, but for the most part, almost all IRAs no longer have the ability to stretch. They further increased the RMD age from 72, they're increasing it to age 75. Increased catch-up provisions for workers older than 60, and increasing credits to small businesses for establishing retirement plans. Again, just to encourage individuals to be able to save, and for businesses to help their employees be able to save. Another tax that was being talked about in February, I haven't heard much about it lately, but it was being proposed, was an excess profit tax. And this was really after last year's year-end earnings were reported out in January, beginning of February. There was a lot of talk on this. And it's something that the US actually has done before. They most recently used it from 1940 to 1950, where it was being used to fund to increase taxes during World War II. Oops. During World War II, in 1 and 2. And what it tries to do is it tries to levy punitive taxes for corporations that are quote unquote unfairly benefiting from that crisis. So in this situation, if you look at who's benefited from the last 18 months of COVID, it's been a lot of the tech companies, Amazons, the Walmarts, the larger companies that were able to avoid shutdowns and whose revenue has gone up exponentially as a result of that. What they want to do is, in the way it's worked in the past, is you set a baseline average for the 4 years prior to the crisis, and then you adjust it for inflation. And the way it's been done in the past is you get to adjust, 8% for your first million or first 5 million of growth, 6% for your next 5 million, and 5% over 10 million for that 4-year average. But then anything over that growth mark is taxed at 95%. So basically they say, well, if you made more than 10% over those 4 years, if you had more than a 10% increase, we're just going to take all of it in taxes because it wasn't quote unquote fair that you made that money. The talk of this has dropped off, but again, I think there's a lot of desperation in looking at how do they potentially fund, back fund all this stimulus that's been given out over the last 18 months, and not to mention all the infrastructure improvement, everything else that the government would like to focus on. Where are they coming up with the money for it? So this was another tax that's been talked about. I don't think that anything will come of this one, but it is something that had been talked about in the last few months. Oh, let's see here. Things to be aware of in this. The way the capital gains law is proposed in the current budget is, if the budget were to pass as is, which is almost impossible. I mean, there's a good chance we won't have a budget for 2022. But if the capital gains was passed the way it's proposed, it would be retro to when the budget was filed, which was April 28th. So when the budget was introduced to the House, that is when the capital gains change could, in theory, go into effect. So it'd be retroactive to April 28th. So that means if you sold a company in June or July or even last month, you could be subject to a much higher capital gains rate than what the law actually states right now. I don't think there's any chance that would take effect. But again, that is something to at least be aware of. This capital gains law has huge impacts on wealth transfer, because if you're moving assets to a trust, if you're moving assets at death, you're triggering taxes outside of estate tax, and you're triggering taxes to a much larger percentage of the population than what would normally be subject to these taxes. Also limit years on Dynasty trusts. So Dynasty trusts are these multi-generational trusts. Right now in certain states, these trusts can go on in perpetuity, but they would, there's talk about wanting to limit how long those trusts can stay in force for. The other thing is the 1031 change they're talking about is not just for real estate. It affects broadband spectrums, fast food licenses, aircrafts, vehicles, which I think is a huge one, boats, livestock, artwork, collectibles. So any of these assets, especially if any assets you're taking depreciation on that are personal use business assets or personally owned business assets, you lose the ability to 1031 those. The flip side of that is you can immediately expense the new asset, the replacement asset, and you can do full expensing in 2022, but that will be weaned out over the next 4 years. So, if you sell an asset and there was a huge gain in it, but you use that to buy your new asset, the depreciation of the new asset is just going to offset that gain. It still is not as favorable as what the old rules would have been, but at least it's, it works for the time being. But as I said, that full expensing is temporary, whereby 2026, you're down to 20% of what of the expense you're allowed to take on that new asset. Now, again, these are things that are in the proposed budget. The likelihood of them taking effect like this is minimal. The real estate industry has an incredible lobbying group, and the way the 1031 rule is proposed right now would have potentially devastating effects on the real estate markets. So we'll see what happens. But these are the things that could potentially generate the most amount of revenue when you look at this budget. What's not in the budget but still proposed? So 2 months before the budget was proposed, there was a for the 99.5% Act proposed that was introduced into Congress. This is the one that addressed the estate tax, because in the current budget, the estate tax is not addressed. It's not talked about at all. Capital gains taxes and the effect it would have on gifting and the effect it would have on estate tax planning is there, but it does not actually have anything about the current estate tax in the current budget. But this was introduced a month or two before the budget, and this is what talks about reducing the gift tax exemption to $1 million, reducing the estate and generation skipping transfer tax to $3.5 million from the current $11.7 million per person, and it would bring back a scale. Right now we're at 40% federal estate tax. It would bring back the scale in $3.5 to $10 million estates would be at 45%, and it would go all the way up to 65% depending on the size of the estate. The other huge ramification of it is proposing to reduce the amount you're allowed to do in annual gifts before they have to go against your lifetime exemption. Right now, you can give $14,000 per person. So you have $14,000 you can give to anyone you want, and you can give it to as many people as you want, and your spouse has the ability to do that as well. So in theory, you can give, if you're married, you can give $28,000 away to each recipient. This proposes to bring that down to $10,000 per, but $20,000 total. So you have the ability to give away $20,000 across the board, regardless of how many people there are, and same with your spouse, where some people are giving away hundreds of thousands of dollars a year under that annual gift exclusion. This would take it down to $20,000 per individual, per individual gift maker, not receiver. Additional things for the 99.5% is that's where the Dynasty Trust language is. They would try to eliminate or greatly limit the valuation discounts for businesses not actively engaged in trade. So think of this as any family limited partnerships or business entities that are being set up for the family as opposed to actual business purposes. They also want to eliminate the defective feature of a grantor trust. If anyone is familiar with grantor trust, these are trusts where I can make a gift to a trust for the benefit of my spouse or kids, and it's exempt from my estate and any of their estates, depending on how it's structured. But I have the ability to continue to pay income tax and capital gains tax out of my personal estate on behalf of that trust. So it allows you to give more in that effect. The other part of that, the other beneficial part of that is if you enter into a sale transaction with a grantor trust, it does not trigger capital gains. They get rid of this feature. Now, if you move those assets either through gift or sale to a trust like this, it will trigger a capital gains event. The last part that they're looking at is GRATs. This has been talked about for the last 10, 15 years. Grantor retained annuity trust, which was made most famous by the Waltons. They're the ones who had the private letter ruling, and this is their family's main estate strategy, is putting the minimum period on these as 10 years. where currently it's 2 years, but also changing and saying that right now a percentage of that trust of the greater of $500,000 or 25% would have to be claimed as a gift, where right now the grantor retained annuity trusts, the whole purpose of them is to do them to try to zero out any gift implication. It ends up being like you can transfer a few $1,000,000 and it takes up $5 or $6 of gift if it's done correctly. Projected revenues from the tax changes. This is on the individual side. You can see that moving the top individual tax bracket to 39.6 has a fairly substantial impact on taxes for the next few years. Keep in mind that this is only going through 2025 because right now the current tax law is set to expire in 2026. Same with the estate tax thresholds. Same with a few of these. The corporate tax rate of 21% as opposed to 28%. All of those are already set to sunset out at the end of 2025. So that's where you see if they increase this, this is the annual impact for the next 4 years, but then it results to zero because it's already set to go back to that rate. Tax on unrealized capital gains is a huge number as time goes on. Same thing with imposing income, net income, investment income tax, that NIIT tax I talked about. Again, that's that quote unquote Medicaid or Medicare tax on passive income. Here's the good news, if there's good news, but particularly for your industry. The good news is there's a tremendous amount of infrastructure spending in this bill. There's about just under $600 million in transportation infrastructure. There's 30 million in drinking water infrastructure and broadband infrastructure. About 1.7 billion is, we'll call it 1.5 billion of the 1.7 billion in this bill is on infrastructure spending, which could have positive impacts on the construction industry and keep things going on that front. So the infrastructure spending bill, over the next 10-year period of time has a tremendous amount of potential benefit. In this infrastructure spending bill is the one that's primarily, the taxes are primarily targeting these large multinational corporations, and it's primarily targeting the large corporations who've had the biggest increase in revenue and profit over the last 2 years during this as a result of the COVID crisis. They were also, again, as I said, really trying to target the private equity, hedge fund, investment banking world in what you're seeing in what their proposed or their claimed taxes are. Last week there was a big leak on the tax returns for people like Warren Buffett and Elon Musk and a few others. And it seems like every day, depending on the news sites you follow, there are reports putting that class of individual into a very, very negative light for what they're paying in taxes relative to their net worth. Well, again, that's not the way the U.S. tax code works. So they're really trying to skew this messaging and skew the story to target those individuals. But it will have some fairly substantial ripple effects down market to really what's considered that mass affluent, which is clients who have $1 million to 2 million of assets or more. Some of these tax codes could potentially have a huge impact on the way those assets pass from one generation to another, or what you walk away with if and when you sell your company. So that is pretty much it for what I have on the tax law changes and the rumors. The reality is, when you look at what's going on in the world and what potentially could happen, the likelihood is we won't have a budget for 2022. It seems very rare over the last 20 years where we actually have a budget that's passed. The highest probability of a budget being passed is in the first year of a president's term, especially when they hold both branches of Congress. But it's unlikely that that's going to happen this year. There's already yesterday there was a group of 5 Democrats who came out against the budget and said we need to get a better plan in for deficit spending. This budget will add about another 1.2 trillion to the deficit in the first year. So there's a lot of concern about that, and it's unlikely that in my opinion, again, this is just my opinion, unlikely that it'll get passed the way it's being presented, but there is the probability of that or possibility of it. And the reality is some of these tax laws are going to happen at some point in time. We know if nothing happens at the end of 2025 going into 2026, all of Trump's tax cuts, so the corporate tax rate, capital gains rate, the highest to ordinary income rate, all of those will sunset out and all of those will increase. The one nice thing is that the IRS has given guidance for anyone using their lifetime exemption under the current rules, which is 11.7 million per person. If anyone uses that while the rule is in effect, so right now, there will be no clawback of that. So if you give 11.7 million while you're alive, or 5 million or 6 million, whatever it might be, and these rules take effect and the lifetime limit's $1 million and the lifetime estate exemption is 3.5, there will be no clawback for the planning that's already been done. So the mentality to this point in time has been, let's get the ball rolling. Let's make sure we're doing things that we're planning properly, and start to get some of these strategies in play so that they can hopefully be grandfathered in if and when change happens. So that's what I have. I wanted to try to keep this as tight as possible, right about the half-hour mark right now. I'd be more than willing to take a few questions if anyone has any. And if not, I appreciate everyone tuning in. This has been recorded if anyone wants a copy of it to be able to rewatch it. But as I said, if anyone has any questions, feel free to take yourself off mute or put them in the chat. It doesn't look like there's any questions. So I appreciate everyone logging in today and taking the time to listen to this. And as I said, if there's anything else or any questions or follow-up, some of you have my contact information. Zoe may have put it out with the invitation. If not, I'll make sure she pushes it back out, and you can feel free to reach out to me directly. But I appreciate everyone taking the time to log in today.
Thank you very much. Appreciate it.
No problem.